Today we'll be discussing the part of a company analysis project as part of our corporate finance module of the MBA. The company which I have chosen for the company analysis project is Costco. So when we talk about the company, sorry. So when we talk about the company is a well-established retail joint with a global presence. It was founded in 1983 in Seattle, Washington, and currently it has built its reputation as a unique business model, which is member-centric, with and makes them, available nationally branded and private label products at low prices. The core philosophy is how it can drive high sales volume, and a lot of it focuses on a very dynamic and a well developed supply chain, which allows rapid inventory turnover. One of the key aspects of Costco's success in a good inventory management is that it is able to directly procure from the manufacturers through cross-docking consolidation points or depots. This ensures minimal handling and reduction in cost and increase efficiency. Therefore, company depots are designed in a way that they are able to receive large shipments from manufacturers and quickly distribute these goods to the warehouses. Its warehouse size is quite standardized and is based on a lot of iterations and data based on its earlier experiences. So it is approximately 146,000 square feet and is designed for space efficiency and easy event control. Now, as I mentioned earlier, it has a membership format and therefore it has a strict control of entrances and exits, which prevents inventory losses as compared to its other competitors. It also operates with shorter hours of operation, which reduces the labor cost and also again prevents loss of inventory. It also operates gasoline operations which have extended hours through various payment methods, including credit cards, debit cards, cash checks, etc. Its overall strategy is to provide members with high quality merchandise at lower prices, and they ensure it by limiting most items to fast selling models, size, and colors, maintaining a lean inventory. So it can, therefore, the key aspects of corporation's success is a unique business model, which is focusing on providing value through efficient operations and a dedication to customer satisfaction. Now, the industry is, as I mentioned earlier, it's the retail industry of which the Costco is part of, specifically the warehouse club and superstore sectors. The other competitors of Costco in this space include Sam's Club, BJ's Wholesale Club, Walmart, etc. However, what makes Costco different from these is that they have carved out a unique niche by emphasizing low prices, value for money, and limited but carefully curated product selection. Now, the project required us to explore two latest news items about Costco. So I have chosen these two articles. The first one alludes to a superior model international expansion from September 28th. This article says that Costco is a leader in North America in the wholesale structure. It is projected to increase, like-for-like scales by 3%, which is in on par with Walmart and ahead of many competitors like Kroger and Target. It also talks about how its model of wholesale offerings low price and frequent inventory turnover has been a resounding success. Over the past decade, the company has achieved an impressive growth rate of 8.7% with a profit growth rate of 10.2. This has actually given the investors a quite good return on their investment, and this has been possible because Costco has been able to maintain a strong financial performance. Its return on equity surpasses the major retails like Walmart, Carrefour, Tesco. And therefore the rising interest rates have boosted Costco's financial results, which has also helped in maintaining substantial cash reserves to manage its debts. And no doubt the Costco's stock price therefore has quadrupled over the past decade. Second article is about a bit in contrast to the above, where above article talks about how the Costco model has been very successful model. The second article talks about how there has been an in-selling of the Costco shares, which is alluding to potential weakness. So this article talks about from September 24, 2023, talks about that in past 1 year, many of its of its internal shareholders have sold shares, which is to an amount of approximately 2 million at the rate of 518 per share, which is less than the market price of 559, which indicates that the employees or the shareholders which is within the company feel that the shares are overpriced and they have already achieved the growth that they anticipated it to achieve, and therefore they have they have started in selling because they feel that there will be no further growth, and if there is a correction in the price, it will lead to a loss, which is highlighted as a potential weakness for the company. However, it also mentions that these insider ownership is just 0.2% of the company's share, and therefore this also highlights how the capital structure of the company is designed very intelligently, and company takes a lot of efforts to design its capital structure in a way so that if such kind of events happen, it does not affect the overall company reputation and outcomes. Now, when we discuss about financial statements and ratios, if we just look through the balance sheets, the cash flows, etc., we were asked to observe two key observations. So, two key observations which I saw was first a reduction in the repurchase of capital stock by 250%. So, from 2020 to 23, there has been a 250% decrease in the repurchase of capital stock by Costco, which means that Costco has reduced the share buyback activity. This means the Costco has been repurposing its capital structure to conserve its capital, which means that the company is saving its capital, which can mean that it has a good financial prudence. And it is prioritizing financial stability and flexibility. There might be shift in priorities, especially after COVID, where company might be focusing on investing more in physical assets, and therefore they want to have enough capital for the same. The company might be redirecting its capital towards potential investment, therefore it is preventing buyback, and therefore, lastly, keeping in mind the COVID pandemic, it wants to keep itself prepared for any market conditions and other external factors which might affect the company's financials or capital structure. So second is reduction in Costco's debt by 13%. So we can see that over the 3 years, Costco's debt has decreased from approximately $10 billion to $8 billion, which has several financial implications. First of all, debt reduction indicates that they have been actively managing its long and short-term outstanding debts because it wants to strengthen its balance sheets, lower the interest expenses, and reduce financial risk. The capital allocation or the capital structure is also is changing for the company, or the company is focusing on changing the capital structure, which can also be seen from the point above, where they have decided to reduce the number of stock buybacks. Therefore, this means that they might want to refocus the capital towards debt reduction, which will improve the overall investors' confidence in the company, and they would like to invest more in the company. Now, when we talk about key financial ratios, we see that when we talk about liquidity ratios, the current ratio has increased from 2021 to 23 from 1 to 1.07. The quick ratio has also shown a gradual increase after a dip in 2022, where it stands at 0.57 from 0.52. The total asset turnover has increased. The fixed asset turnover has also increased from 7.43 to 8.24. Debt management ratios, debt to asset ratio has decreased from 17% to 12.88%, and the times interest earned has also increased substantially from 40 to 54. The operating margin has slightly increased. The profit margin has also slightly increased accordingly. The basic earning power has increased. Return on assets has also increased, and the return on equity has decreased from 2021 from 27 to 25.11. When we talk about the market value ratios, the number of shares, the market capitalization stands at around two, 25 billion. Yeah, sorry. So and therefore the overall price to earning ratio is around 40.2. The market to book ratio is 10.1. Now, when we focus on the current ratio, as I mentioned earlier, has shown a very good increase of 1.0 from 1 to 1.07 from 2021 to 2023. This suggests that the balance between the short-term assets and liabilities, is good, and which reflects a stable liquidity position. Because the ratio of more than 1.0 suggests that Costco has more current assets than current liabilities, which can be used to cover its short-term obligation. It also is a sign of improved operational efficiency, and also means that Costco is managing its work capital more effectively. Therefore, the increasing trend suggests improved short-term liquidity and financial stability. The return on assets, as I mentioned earlier, has also shown an increasing trend, which suggests that the Costco has growing profitability. For every dollar of assets employed, Costco is earning a high return, which is attractive for the investors. And the upward trend from 2021 to 23 reflects efficient asset utilization, improved profitability, and potential for sustained growth. Therefore, the company is effectively managing its resources to generate high returns. When we compare the current ratio with a comparable company like Walmart, we see that Walmart has been maintaining a current ratio of less than 1, and which has again shown a decreasing trend from 2021 and currently stands at 0.82. Therefore, this raises a concern about company's ability to cover its short-term liabilities, and also suggests that Walmart has excessive inventory, which is tying up its capital and reducing the liquidity. Therefore, based on the current ratio, Costco appears to be a better performing company as compared to its competitor, Walmart. When we talk about return on assets, the return on assets also for Walmart has reduced from 5.42 to 4.64, which again means that it has inefficient asset utilization, and also suggests that it has various investments, which are affecting its overall profitability. For example, investment in e-commerce, international expansion, which requires capital for investing in physical assets like building new warehouses, building new software, hiring software professionals. Thus, Walmart needs to assess its operations, cost structures, and revenue streams to improve the efficiency. Therefore, investors, may be wary of this trend, as declining ROA could affect the shareholder returns and stock performances. When we talk about cost of debt, we have already mentioned about the liquidity ratios. We were asked to So based on these financial ratios, Costco appears to be in a good financial strength with a strong ability to cover its short-term obligations and a conservative level of debt and robust capacity to meet its interest expenses, which positively contributes to its creditworthiness. Now we were asked to analyze one of the bonds from Costco. This is the bond which I have analyzed. Though the assignment required us to have a bond which has a maturity of beyond 10 years, that is 2032 and beyond. However, we were not able to find the bond for Costco. Therefore, I could only use this bond for the analysis, but I performed the analysis accordingly. So when we talk about the bond, the issue price is 99.20. It was issued in 2020 with a maturity date of 20 October 2032. The face value currently is 78.24 with a yield of 5.434% and a coupon rate of 1.7450. So when we analyze this, we see that the yield to maturity is 5.43, which represents the expected annualized rate of return as an investor. The coupon rate of 1.750 means that the issuer pays an annual interest of 1.70 for the face value to the bondholders. So this will be equal to approximately $1.4 annually. The issue price is 99.80, which is above the face value, which means that the investors are willing to pay a higher value for buying this bond, maybe because the Costco's overall financial capability and its capability to give back to its investors is very high, as we have seen in our previous analysis of the various indicators or the ratios. So when we use the CAMP model or the capital asset pricing model, we see that according to the CAMP model, the beta is 77 or 0.7730. The risk-free rate is 4.78 and the return on market portfolio is 52.21%. So based on this, the required return of stock is 9.59%. When we compare the beta of Costco and Walmart, we see that the Walmart's beta is 0.49, which means that though Costco, is giving a higher return, it is more volatile as compared to Walmart, which is giving a steady return but is less volatile. Therefore, for a risk-averse investment, I would prefer Walmart with its lower beta, which suggests it is less volatile than the Costco share. And this is also indicated in the article where we saw some internal selling of shares by the employees, because that indicates that the Costco share is overpriced, and therefore there might be some correction which may lead to some loss. Therefore, and this again is corroborated by a beta of 0.77, which is higher than Walmart's. Therefore, as a risk-averse investment, I reiterate that I would prefer Walmart over Costco. Now, talking about dividends, when we compare Costco and Walmart, Costco gives a higher dividend of 1.02%, and it gives us quarterly, and over 5 years it has increased from 0.57 to 1.02 with a dividend yield of 0.72% and a PE ratio of 39.3. Similarly, when we talk about Walmart, it is currently paying a dividend of 3.02 and quarterly. That means every quarter it is paying $0.52, and it has increased very slightly 0.52 to 0.57, which is a 9% increase. Therefore, the overall dividend yield is 1.43 and the PE ratio is 30.8. So when we compare, Costco has substantially increased its dividends over the last 5 years, but Walmart has a stable dividend payout, but with a higher yield. So because if we can see, the dividend yield is 0.72% for Costco and it is 1.43 for Walmart. Similarly, PE ratio suggests that while the investors are willing to pay a higher price for Costco due to its liquidative rise in dividends, but Walmart on the other hand might be a more stable choice due to its lower PE and higher yield ratio. higher dividend yield. Now, change in dividend payout, we see that Costco has a very unique trend in its dividend payout, which we can see in last kind of 10 12 years. Whenever it has a good profit, it tends to increase its dividend payout. For example, in 2020, it paid a dividend payout of $10, which is like almost 120% of its current, which is 4.02, which aggregates to $4.4 billion. This is the fourth special dividend paid by the company in last 8 years. The last was in 2017, which was $7, in 2015 of $5, and December 12, which is of $7 again. The key reasons can be that the companies had a strong financial year in 2020 with a 9.3% growth in net sales and 77.7% in comparable sales, with the e-commerce sales spiking nearly 20%. So this e-commerce scales maybe because of the COVID pandemic. More and more people were buying through e-commerce website, and Costco was very smart in investing in the in expanding its e-commerce platform, which might be responsible for its with the spike in the sales. Its net income reached 4 billion, which indicates financial stability and robust profitability. The dividend policy has for the company has been such, as mentioned earlier, it has a history of paying high dividends whenever they have substantially higher profits. And again, it also suggests it has a consistent growth and a good market performance over the past 10 12 years. When we talk about the capital structure, we see this is the pie chart which shows the capital structure. We see that the capital structure is mainly focused on common equity and invested capital, which invested capital. So this indicates that it has the company is using a cautious approach to financing with a predominant reliance on equity and limited use of debt, which while this presents as a low leverage profile, it is imperative to assess how this aligns with the company's strategic goals, and we'll see that in the document below. We see that the Costco's capital structure has saw a significant change from 2021 to 23, with the working capital in the following aspects. First of all, the working capital management. The working capital has substantially increased from 64 million to 2926 million, which shows that it has increased ability to manage short-term obligations and potential investments, and also implies a strategic holding of liquid assets to safeguard against market volatilities, financial operational expansion, and for strategic investments. The liquidity ratio again has moved to 1 to 1.07, which signifies a slight improvement in short-term liquidity and a positive sign for creditors. The quick ratio has increased to 0.757, and while it is still below 1, it indicates a marginal increase in financial health. Also, it also indicates operational efficiency in terms of improved fixed asset turnover from 7.42 to 8.24, which we have seen is a focus for the company, because inventory management is a key aspect of how it is able to manage the customer's demand and is able to maintain low prices for key items which are available to its members. It also shows that the company is very good at management debts, because the debt to asset ratio has decreased from 18 to 13%. And therefore the company's capital structure is being shifted to a less debt reliant capital structure. The short-term borrowing has increased, which suggests that the company is relying on short-term financing for operational and strategic needs. On the other hand, the long-term debt has reduced from almost by 50%, from $5,572 million to $2,630 million, which means there is deleveraging in long-term obligations, and an increase in short-term borrowings along with decrease in long-term debt reduction hints towards financing specific strategic initiatives or capitalizing on favorable short-term borrowings. Now, one of the key reasons why there has been a substantial change in the capital structure from 2021 to 2023 can be the COVID pandemic. The pandemic has had led to an increase in demand for essentials and move towards bulk purchasing, uplifting its sales. The e-commerce, as I mentioned earlier, has taken a front seat, and the company has focused on making its e-commerce platform more robust to focusing on IT resilient and IT manpower. Uh, the disruptions in supply chains due to lockdowns might have necessitated the company to adapt to new innovative strategies, and possibly might have elevated the cost for the same. With the COVID pandemic, safety was a key concern, not only of the assets in terms of physical assets, but also of the human resource, and therefore it required additional resources. Uh, as per the annual report, Costco continued, it paid premium salaries to the employees for their health and well-being during the pandemic, and they continue to pay that higher price or the salaries to the employees even beyond or the post-pandemic as well, which added to the cost to the company. There is an increase in working capital and short-term borrowings, which can be attributed to ensuring liquidity amidst the uncertainties and for financing the above adaptations. Talking about post-pandemic recovery, the company, as per its annual reports and various news reports, has been continuing to focus on strengthening its e-commerce growth. There is increase in ensuring that there is a working capital to expand in terms of uh, making new warehouses as well as strengthening the online e-commerce platform. When we talk about the weighted average cost of corporate capital, we see that the cost of debt is 5.43, cost of equity in terms of risk-free rate is 4.78, return on market is 11%, beta is 0.77, therefore the cost of equity is 9.57. The tax rate for Costco is 25.9, and therefore WACC is 10.52. So when we talk about forecasting, uh, we have seen that the Costco has gone into some new ventures. For example, the partnership with CSAM Health, is a healthcare delivery platform which Costco is partnering with to ensure that its members can access and or have access to affordable and accessible healthcare services. And it also means, because it's a digital or a telemedicine based healthcare delivery system, it also means that the investment it is being it is making in strengthening its e-commerce platform to focusing on IT platforms and IT human resource can be leveraged for ensuring that it can be used for telemedicine services for its members through agencies like CSAM Health. So it also echoes brand's commitment to providing diverse member-centric offerings, and as I mentioned earlier, it's a visionary approach as it focuses on retail and healthcare amalgamation of retail and healthcare industries, underscoring adaptability, innovation, and member centricity. Second is acquisition of Innoval. So Innoval is the backbone of Costco's very robust supply chain and inventory management system. So I think Costco made a very great investment in by acquisition of Innoval, because it this allowed Costco to steadfastly uphold its commitment to providing customers with low prices without surrendering on quality. Innoval demonstrated strategic foresight by preemptively moving inventory to Costco's warehouses prior to its peak demand. For example, during Thanksgiving, through Christmas, New Year, etc. This proactive approach precluded potential inventory shortages, ensuring high demand items remained available, and also ensured that the holiday season could be catered to, leading in high customer satisfaction. Therefore, this strategic enhancement and acquisitions not only addressed logistical challenges, but also provide the company with a competitive edge as compared to its competitors in the market. When we talk about lawsuits, currently there is one lawsuit which is major, which is the Dolphin-Free Tuna claim, wherein one of the plaintiff of the customers, Melinda Wright, has filed a case with the U.S. District Judge William U.S. District Judge William Orick, wherein the complaint is around that while the packaging mentioned that the tuna in the can is dolphin safe, but the claim which Melinda Wright alleges is that it is falsely asserted because and because the filament or the commodity which is used to catch the tuna is harmful for dolphins. Therefore, therefore, the right, this and therefore the rights case remains pending and is significant because it also focuses on consumers' preference for dolphins, safe labeled trauma, and labeled tuna, and therefore the outcome of the case may also impact customers, Costco's reliability among the customers in terms of providing the products which are environmentally safe, and also Costco's commitment to ensure that whatever it mentions in its packaging is according to the US laws and it is true whatever it mentions on the packaging. Now, overall, the company has exhibited a remarkable trajectory of growth and strategic evolution. It's not only a bulk retail powerhouse, but also an agile market player, continuously pivoting towards customer needs and market demands. With more than 795 warehouses globally and a membership surpassing 100 billion, it has forged a path of sustained expansion and consumer loyalty. It has an impressive fiscal trajectory from 2021 with an year-on-year revenue increase of 17.5%, reaching to around 200 billion, which speaks about its resilience and strategic adeptness. And the stock has also increased by 50%, which despite the various challenges like the COVID pandemic. Now, so when we conclude about whether we should one should invest in Costco or not. So there are several factors which need to be taken into account. For example, current and quick ratios, which we have talked about earlier, total asset ratio, which we had mentioned earlier, operating and profit margins, return on assets and equity, and PE ratios, and lastly the MB ratios, WACCs, beta, and debt to asset ratios. So based on these ratios, which we have already talked about in detail earlier, I feel that that if I already have the some of the shares of Costco, I will continue holding them because I see a potential growth. But because the new shares, if are bought at a premium as compared to the anticipated price, I will not invest in buying new shares. Because I will rather focus on something which is less vulnerable and less volatile and less risky. But for the shares which I already have, I will definitely not sell those shares. And the reason for that is, despite Costco being able to build a reputation as a stable investment, primarily due to its resilient business model, investing in Costco, as I mentioned earlier, comes at a premium. It has a high PE ratio. Shares are considerably expensive. And while the company has demonstrated steady growth and robust financial performance, I will ponder whether the current stock price offers a favorable entry point, considering factors like dividend yield, future growth potential, and company's ongoing ventures into e-commerce platforms. Therefore, for me, stability is more important as compared to a lofty price tag for entry into an investment. So therefore, I reiterate, if I already have the shares of Costco, I will hold them. But buying additional shares will depend upon how much extra liquidity or financial capability I have to buy a share at a premium. With that, I end my presentation. Thank you.